Welcome one and all. In today's video, we're going to be talking about corporate bond yields and credit spreads. Now we can use this information as one more gauge of overall fear and perceptions of risk in the market. This is going to allow us to allocate our portfolios appropriately and to position ourselves in anticipation of changing market conditions. So without further ado, let's dive in and learn a little bit more about corporate bond yields and credit spreads. So before we dive into our discussion on credit spreads and how we can use them to guide our investments, we need to first touch on the concept of bond ratings. Now, here in the United States, there are three main independent credit rating agencies, those being Moody's, Standard & Poor's, and Fitch. Now, these three companies are tasked with performing due diligence as to the financial situation and creditworthiness of publicly traded companies. When I say creditworthiness, I'm referring to a company's ability to service its debt. Or in other words, a company's ability to make the interest payments associated with its debt. You see, when a company needs to raise capital to fund new projects, one of the options they have is to issue bonds, which in essence means they're taking out loans from the purchasers of the bonds. Now, interest payments need to be made to the holders of the bonds at regular intervals. And in addition, the principal of the loan will need to be paid back when the bond comes due, when the bond matures. So these credit rating agencies come through and evaluate a company's ability to service their debt. And in doing so, they assign them a letter grade, essentially, that's going to tell investors and potential purchasers of these bonds how likely the company is to be able to service that debt and to repay that debt when it comes due. So a company's credit rating is a pretty big deal because it's going to indicate what an independent rating agency has identified as the level of risk associated with that company and their ability to service their debt. Each of the credit rating agencies has its own letter grading scale, and they're all slightly different. But in general, a company with a rating of BBB or above is considered investment grade. These are high quality companies with low risk of default. Those companies with credit ratings of BB or below are considered non-investment grade. These are going to be higher risk, lower quality companies. The bonds issued by these companies are also known as non-investment grade, high yield, or junk bonds. So as you can imagine, companies with lower credit ratings and higher risk will have higher interest rates associated with their bonds. And that's due to the fact that investors are going to need to be compensated appropriately for the elevated risk levels associated with the debt of that company. When you think about the spectrum of the bonds available to investors, on the safest end of the spectrum, you have U.S. Treasuries. Now, these are said to be virtually risk-free because it's highly unlikely that the U.S. government is going to go bankrupt and default on its debt obligations. Next in line is investment-grade corporate debt. So this is debt offered by highly stable, high-quality companies that are pretty unlikely to default on their debt. Next, you have the non-investment grade corporate debt category. These are going to be companies with credit ratings of BB or below. Now you're getting into high yield or junk bond territory. These are going to be riskier than investment grade bonds and associated with higher interest rates. And lastly, at the bottom of the non-investment grade corporate debt category are D-rated bonds, which are typically associated with companies that are already in default. And to clarify, to default just means a company is unable to pay back its debts. Typically, this means the company has already started its bankruptcy filings. So to recap all that, bond ratings, aka credit ratings, just refer to the creditworthiness of a company as measured by a third-party credit rating agency. Now, the higher quality the company, the better grade it's going to have, the lower the interest rate that will be associated with its bond offerings. So up to this point, we've just been talking about the relative level of interest rates associated with bonds of varying credit ratings. The next step is the concept of bond yields. So yields goes a step further than simple interest rates and describes the annualized rate of return that an investor stands to profit when they purchase a bond. So it's a factor of both the interest rate associated with the bond and the price that the investor pays for the bond. So I don't want to go into too much detail about how bond yields work, and I encourage you guys to refer to some of our Finance 101 material if this concept is confusing to you. But just know that in general, high higher interest rates are going to be associated with higher yields, but that's only one part of the yield equation. You see, the interest rate associated with the bond is set before the bond is even issued, and that's not ever going to change. But the yield of a bond can change, and that's a factor of the price the investor pays. So when an investor purchases a bond in the secondary market, the price they pay is going to be a factor of supply and demand. So the lower the price they pay, the higher the return on their investment is going to be, the higher the yield will be. So when you see bond yields changing, that's usually a factor of changing bond prices. So when you see bond yields rising, that means that the prices of those bonds are declining. Prices would be declining because investors are seeing that there's more risk associated with those bonds and are thus demanding a higher yield to compensate them for the increased risk. So when you see bond yields spiking, that might not necessarily mean that there's actually more risk, but it does mean that investors are perceiving that there's more risk associated with that company and their ability to service their debt. Let's pop into the market barometer to see some of this stuff at work. So this top chart here is the corporate bond yields chart. And so in white here, we have AAA rated corporate bonds. In this light blue color is BBB rated, and red is high yield corporate debt. So you can see that the relative levels are indicating that, you're going to have lower yields associated with safer companies, higher yields associated with riskier companies. So the fluctuations in the yields is what is really important to us as investors and traders. Because again, that's going to give us an idea of investors' perception of the changing riskiness of these companies through time. So what we're looking at here is the average yield on bonds of varying credit ratings. In addition to that, all of these bonds have the same length to maturity, 10 years. So we can get an idea of the relative yield on bonds of various credit ratings while negating the time factor. So while a changing yield for an individual company might clue you into what investors are perceiving as the risk associated with that individual company, what we're looking at here is investors' perception of risk associated with companies at different points along the risk spectrum. So what does this all mean? How do we read it? And what is it telling us? There's a couple key pieces of information that we can derive from this page of the market barometer. Namely, when overall corporate bond yield levels are spiking, it's telling us that investors are more fearful about the ability of all companies in the market to service their debt. So we can use corporate bond yields as one gauge of fear in the market and of investors' perception of overall risk levels. So spiking corporate bond yields indicates an increased risk level as perceived by investors. The next piece of information that we can derive from corporate bond yields brings us to the concept of credit spreads. So a credit spread just looks at the difference between the yield on bonds of various credit ratings. And that's what these three charts in the bottom of the market barometer here. The one on the left, we're looking at 10-year AAA rated bonds minus 10-year US Treasuries. So this is going to be the difference between virtually risk-free US Treasuries and the highest quality AAA rated investment grade bonds. In the second chart here, the middle chart, we have 10-year high yield minus 10-year US Treasuries. So that's going to take, your non-investment grade bonds and subtract the risk-free rate or the yield on US Treasuries. Lastly, the chart on the right is high yield minus AAA. So this is going to be the difference between non-investment grade and investment grade corporate bonds. So again, all three of these charts are basically just telling us how big the spread is between the yields on bonds of various credit ratings. So what does this mean? How do we read it? And what does it tell us about the macroeconomic picture? Whenever you see any of these three charts moving up, that's indicating that the difference between yields on lower quality companies is growing relative to the yield on bonds issued by higher quality companies, which means that investors are more fearful that the lowest quality companies are becoming less able to service their debt. This indicates greater fear as perceived by investors, and by extension of that, more risk in the market. So to recap, when we see credit spreads spiking, that just indicates to us that the difference between the yields on higher risk bonds and lower risk bonds is widening. So when we see widening credit spreads, that indicates to us that investors are perceiving more risk in the market. That investors have become less confident that the riskier companies are going to be able to continue to meet their debt obligations. So key takeaway regarding corporate bond yields and credit spreads is that they offer us one more glimpse into the state of the economy and the current macroeconomic environment by way of investors' perceptions of fear and risk in the market. So if you guys like this video, go ahead and subscribe to our channel, hit that like button, leave your comments down below. And until next time, thanks for tuning in. We'll see you guys in the next video.